Welcome everybody, it's the Market Sniper, glad to be back with you. Yes indeed, so what an interesting week coming into this week. It's an interesting week. Central banks all over the place will be reporting their new decisions on interest rates, and the biggest and most important of them all is the Federal Reserve. Will they do a double pointer? How are they, as usual, too far behind the curve and doing a little bit of chase up? Or will they do just a 0.25 or 25 basis points cut? We will see on Wednesday. In fact, it's central bank week. Let's take a look at the map. So over here is a very kindly put together map, courtesy of Bloomberg and shared by one of my Twitter audience, whose name I didn't secure, but thank you to him. These are all the nation states that will be reporting interest rate decisions, whose central banks will be making interest rate decisions over the course of this week. Wednesday in yellow, Thursday pink, and Friday in blue. The main one on the yellow side, in fact there's a couple of biggies, is of course the US of A. There's Brazil, which is actually expected to increase rates, which is a rarity at this moment. And then on Thursday, of course, China is huge as well. China is expected to maintain rates. Brazil is expected to potentially increase rates. And the Fed is talking about cuts. Now, you know what that does. You know what that does to people that might have invested in America and borrowed somewhere else, such as Japan. We'll come on to them in a second. And the cost of carry, if one is reducing its return and yield whilst others are increasing theirs. Well, let's talk about Thursday. Thursday we'll have Iceland, Norway, the UK expected to hold rates. Now remember, we've given on this channel a GBP USD. So after getting beaten up in the pension crisis for not increasing rates as fast as America, the UK is in a situation where they're likely to be holding interest rates while America cuts. That whole story of being so strong and so dominant and pushing up so high, higher and longer, they've brought the higher and longer, and now they have a wrecked consumer. Turkey, Ukraine as well, Norway will be reporting. Angola is not going to be captivating too many people's interest. South Africa is the only other that may do a cut. Most of the others are expected to hold of the major nations. We didn't go into Indonesia. Then we get to Friday, and that's another big one. You know the problems it caused last time. They are expected to hold rates, Bank of Japan. So that's a quick synopsis on what the expectations are. Remember, any of those statements can turn out wrong. There are always scope for shocks. I don't know the discussions. This is just consensus opinion, and I'm just sharing it as it's given to me. I don't have a view one way or another. It's information for you to consider. Up for Brazil, down for the United States of America. Big central bank week. And let's get to the knitting, the key knitting, by the way, whilst we're in here. And also, for those of you that haven't seen our community platform, this is something of what it looks like. I want to also highlight to you that we have in the links below our key providers for providing gold, because you are going to see why gold has not even begun. If you're outside of the States, go for pure gold. Buy physical pure gold. The link is below. Using pure gold, they'll deliver it to your door. You'll pay what I pay for silver and gold. Also, by the way, you will have the opportunity to use ITM if you are in the States. So if you want a provider that is local to you in the USA, I say local, of course it's a big old island, but is not international of delivery, you can utilize ITM as well. Long-standing family business, 28 years of experience. Also very good guys for securing your bullion. And let's get into why you should be doing that. That, my friends, is your chart. And some of you will be thinking, but Francis, that thing is accelerating. Are you kidding me? It's almost at 2,600. We're hitting a number of 2,582 here. It's going to have to pull back. It's going to have to pull back hard. I will discuss my take on the possibilities, by the way, for the rates, 25 or 50, and what the price action may be for gold. At the moment, with that runaway price action, It's a bit of a problem if they go for the full 2 and people start wondering, right, what you're going to do next. It almost smells like panic and pain. As ever, I suspect they're way too late and they're going to have to catch up with bigger moves later. But do they really want to start with a double? That could be a real issue. Don't forget, the dollar index is not very far above the 100 mark and is eyeballing it. The 100 was the level. Let's bring it back up quickly for you and show you that the dollar index was at a level just north of the 100 mark. Let's go into a slightly lower time frame and was eyeballing that. The 100 mark, we got lots of alerts setting the tripwires, of course. And if we just show you where the blue line is, I'm pretty sure it'll show up. There it is, the blue line. Lots of other lines too to join in. But that is very interesting times. And last time you had a technical dip through it and you got repelled. But this time, not as strong. And of course, we have the pound and the euro against the dollar, all with big targets. We've told you a 140 on the pound. So it is dollar overvaluation period. And that is a concern, should be a concern. We've shown you the setup for this particular draw on HVF method. Go and have a look on our others. You're looking at 132, still to go all the way to potentially 140. And there's been a similar one on the Euro USD. Again, watch out for those HVF structures that we drew for you in previous videos. That says 116.5. That's your risk reward, and it's still chundering along just fine. So dollar is looking weak, but who do you want to hold if the dollar is being weak? Well, you can trade the cross currencies. They make it easy for you to do. But what about our Goldilocks? Yes, indeed. Gold is the boy of the moment. It is indeed. And there you go. Lots of draws for you on there. But at the moment, that's where you are on the weekly time frame. Just a little bit of a reminder on the monthly time frame. Boy, oh boy, what a great period. Don't forget, we said when you break the 2K after the third hit, you'll get a wind up and then you will get motoring. 1, 2, 3, 4, 5, 6, 7 months, no red months, 7 months in a row. And you started at just over the 2K. Let's see where it started. We'll get you the low there, 2039, now 2582. That is $550 on every ounce of gold that you held. $550 in every ounce of gold that you held since March of this year. And it was roughly the end of that first quarter with the liar data that they stopped being able to hold the lie together. And from April, May, June into July, the data started to look a bit more murky. The unbelievable labor markets, they were battling to hold on to that lie. They've done all the revisions. We've spoken about it enough times. So lies, damn lies, and statistics. We've also warned you many times, some legacy charts before we show you some of the other ones, where the CPI is showing that you've only really just begun. So when people look at that chart, they'll say, but I'm chasing a spike. You're chasing a spike. Well, in actual fact, there is an upside breakout over here that is certainly on the move, and we can draw you a little structure for that as well using our draw tool. Don't forget, book a call, become part of member of our community, which is here to help you build wealth in reset times. That's right, you are in an upside breakout on the gold versus the CPI as well, and that's going to climb somewhat. By the way, these charts, usually whenever we're on the big time frames, we're normally on log, so I should have it on log scale. But sometimes for people to appreciate the fullness of the actual potential move, we show you it in the regular scale. This is just getting its motoring. It broke out over here. This is on their statistics for gold adjusted to the downside. This break was in and around the 6. It's going to 12. That is a doubling of value compared to the statistic deflator that they are applying. So in spite of being nibbled down on actual buying power by the inflation, it's going to still climb up in double the value. By the way, that was on a monthly. We have to show you, because we don't have the big 1980s in all of that, the fullness of this potential structure and setup. So let's take that away and move it one more time. Whoops, was that the right one. Let's remove that. Let's take it away. There we go. That's the one we want. And show you here what it could be like on the bigger time frame. So when you include the 80 super spike, this is next level. We're going to have to go to log scale and pivot around to get out of this. This is a multi-generational. 78. I was 10 years old in 78. Wow, that was some time ago. And this overall structure is projecting to the 52s, and you are at 8 today. So these numbers don't mean anything, but in terms of the inflation that you're being subjected to, deflating the price of gold, it is still likely to go up another 6 times. Another 6 and some, 6+ times, as part and parcel of this hyper-stagflationary era of devaluing debt. Hyper-stagflationary era of devaluing debt. Did you get that? A lot to consume in all of those words. But this is a monumental move. Pure Gold links below. ITM trading links below. Maximize this with trading. Book a call in our community in one of the most secular bull markets, long-term cycle of generally trade long only upsides. How we explore its HVF method to truly get ahead of that. By the way, let's show you a couple of other interesting charts. All around the gold. This is all about the gold. In central bank week on interest rates, it's all about the gold. The yellow, or the orange should I say, is gold itself. The red is TLT, which I'm utilizing as a long-term debt proxy asset. And I am dividing the performance of gold by the performance of TLT. And as you can see, we've been in a long-term macro bull market. Unfortunately, TLT hasn't been around since the 80s. I would have loved to have done it. I'd used the 10-year. The data's a bit sketchy on the 10-year and the 30 value, not the yield, the value of the debt markets. So here's the key thrust of this particular discussion. Debt markets devalue, gold up values. The greater a massive debt market, which is larger than all of the stock market's market caps, which is huge of itself, of the world, debt markets are larger. That is it. It is literally the alter ego to your currency markets. The debt and currency markets are substantially bigger than the equity markets. And this TLT that was increasing in value brought down this performance of the value of gold. You can see gold was getting away. I was dividing by TLT, but I multiplied by its original value from the list. So that's what's in the formula. It was 82. So it's gold, divide the TLT. It was 82.62 on the first trade of valuation. What's happened recently is you've seen that in the events that we say is the turning point for debt markets, for which they can only largely go down in value. This is in real terms, particularly when adjusted for inflation, but even down in nominal terms as well. You've just had one of the largest periods of nominal decline ever on record for the TLT, certainly. And here it was way up there, and then it's fallen. So it was at one point 107% up on its origination in just before 2003, and then it fell. It gave back 80% of its returns. During this period, gold itself was actually trapped in a broadening structure because we were getting devaluation, immense devaluation on debt markets. And it was basically the liquidity was coming out of the markets to a great degree. Increases of interest rates, all of that happening. That was killing during this period, the debt market. And if we go up here, you will see that gold also peaked out as that came. However, gold did far better. If you take its performance to that point over there, and you take the same period down, you will see that the debt markets were at their lows. So gold was marginally off its highs at that point. I should use a different color. Let's go with the blues. Marginally off its point, and this was substantially down. Substantially down. So that when we are dividing by the value of TLT and it was losing its value, yet we were rebasing by the original value, you actually had a huge bull run in the divided out number. Here you go. This is actually showing that despite gold in dollar terms having gone a little bit down during this period, when you adjust it for the two different systems, the debt-based system, which I've chosen a proxy, imperfect that it is, it's an ETF, TLT, long-term debt holdings, that was losing its value. In actual fact, gold was outperforming chronically. You were yet to get it in the dollar terms, but it was outperforming chronically. And now that the debt is no longer going down, you're getting a mild bid. You are absolutely throwing it up in catch-up terms in gold. And in dollar terms, it is a melt-up while the dollar takes the loss. You see, you're either losing and deflating the debt, which was what was happening here, or you're deflating the currency. Both are the two taps in this large hot water geyser that is having too much hot water and steam poured in at the top, and you've got to release that pressure. There was the debt deval that didn't allow the price to run as they kept the dollar fairly firm, so gold did not get away. Now they're stopping the deval on the debt market. Talking cuts means actual up valuation. What has to happen? Chronic downside devaluation of the dollar. Sorry, milkshake guys. The overall move on the dollar is down and it's looking weak. And if you are to get 140 on the GBP USD, you're going to get 116.5 on the Euro USD. You will be Dixie down through 100. You'll probably be mid-90s. This is a key problem. You've seen it also in the USD JPY, which has skidded recently into further lows. Let's see if we have that somewhere. Let's see if we have it somewhere. There you go. So let's take our beautiful artwork, our Picassos. Since the yen crisis that started it got particularly disorderly, you were already turning down. We had already warned in the Substack that you were getting a bad sell-off in our fear indicator. Stay with gold. Let's stay with gold, where the reason we're here is gold, and we're highlighting that gold CPI chart. But I've got the best charts yet to come. We've also highlighted how gold's reval was building against the debt markets during the debt deval immensely, just by holding its own, just by not going backwards on the escalator that was going downhill, and by marching forward on it and holding its position in this period. Now it's the dollar's turn. They have to put a bit of the bid under debt for a while. The rate cuts. The gold runs hard against the dollar. And let me tell you, this has lost 45% at its worst point to the downside. There is no more easy downside for the debt markets. The dollar's got to be the one that takes the kicking now. And this is what they never tell you when they're talking about how strong the dollar has been and tweeting it out, all of that. The debt market has been dying. The longer the debt market is dying, the sooner it will need to stop, and the sooner the currency will need to take a kicking. As we say, we're looking at the Dixie started in 1973 at 100, and it's busy eyeballing 100, barely much over it. So being long a currency that has done nothing since 73 all the way to 24, when being measured against weak nations like the euro, the pound, and the Japanese, the Swiss franc, etc., is hardly an achievement, having done no upside. So gold is it. Gold is the real discussion. Do not be deceived and taken away from the core opportunity that is gold. Pure gold link below for the rest of the world. ITM link below for Americans. Look at this chart. What have we got up for you here on this chart? Gold. Gold against the M2, the monetary, the flow of money. Let's get the official name for you again. M2. Let me type it in. M2, money flow. It's in the economy. I want to make sure I say it right. Money stock is how they refer to it. There's both velocity of money and money stock. So going back to that chart that's here, this is not a regular scale chart. This is a log scale chart. Let's confirm. No, now it is. Thank you. It shows It shows the key extremities of gold valuation relative to the flow of money, how much new money has been released into the system. So you're sitting there and saying, but Francis, how could you be a buyer of gold? Look how much it's pumped. Let's go back to the gold dollar and just remind you of that particular chart. And the question is, what is your time frame? What is your time frame? Non-advisory basis, the time frame should be on the macro to carry you through reset. We have a bunch of targets from 6.5, 7, 8, and a whole bunch more that we have shared with you previously on why the mighty gold runs and runs and runs, and we'll be giving you some more today with fresh chart takes. But you might say, but surely it's not a good time to buy right now. You know, we've had, I don't know how many green candles. We're on a 3-month, that's a quarter. You've had 4 positive quarters. And in fact, you had 2 small backward ones, that's 6. You've had 7 and 8. Out of 8, you've had 6 up and 2 minor pullbacks in the gold during this period. Well, let's go back to this chart and highlight. This was your 80s. Blow off extreme, your only true, real, full-blown gold bull market. The green line is the hyper undervaluation of gold to the money stock that they are creating and proliferating. And then the top line here is when you might want to start thinking of taking profits. As I've said many times before, the 2011 was not a full, complete bull run. It was capped, but it did move the needle. And you just wicked out at the top level of around 20. So a whole bunch of zeros, just so that we don't have ridiculously low numbers, have been added in there. But it is because the money stock is vast. So dividing by the money stock makes a super small number when you're just comparing the gold price. So that's the formula in there. We'll go back to the log scale in a minute, but super undervaluation period that occurred during 1970, 71, 72 to 74. That was the reaction you ended up. And that first touch, because I'm going to make this point, to the other side and dip down was actually just an A, B, C before a major blow-off leg. Think about that now. This, what I'm just saying to you, this over here was just the first leg of the extremity of blow-off in an absolutely perverted system, then which you are significantly more perverted than today. You have now had on a bigger scaled version much the similar and such greater volatility that you dipped below the undervaluation level right here at this point, and you are just starting to move up. In short, you could be, grabs the orange color cube again, let's do it with a circle, you could be the equivalent of around there. You could be the equivalent of around there by being here. In other words, you've just had your short dip back after you made the other side and are about to have that blow the door off the hinges move. You are just there. On gold, in terms of valuation to the money stock that has been created on their own statistics which probably grossly understate and undermine what is the truth of the full matter. That is, my friends, a scary thought. You are getting a bigger version. You are getting a bigger version of this one up, bounce back down move than the original 80s bull market. That is huge. I will show you this in log scale because when you do big time frames, it's always good to look at it in the log scale. But I wanted you to appreciate the scale of it in regular scale first. I needed you to appreciate the scale of it. The midpoint is 14 between these two values, and I can tell you you're some way off it still just to be in the range after dipping grossly undervalued. That's only happened twice before. In the just 99 through to the dot-com period and 1968 through Vietnam War to the 71 period. Those were huge events that led to the absolute moon spike in precious metals and gold. That is where you are. Okay, now here comes the winner of all the charts, my personal favorite. Had a community member remind me of this one that we'd drawn. And what is this, you ask? Well, it is the gold price as specified in the dollar index terms. You know that thing that started out at 100 in 1973 and is basically 100 today, but took a bit of a journey path where it tracked periods of dollar strength and dollar weakness versus the rest of the basket. Well, the beautiful thing about it, my fine friends and watchers, and you will know us as the purveyors of HVF method, Hunt Volatility Funnel method, which is the best trading tool from a low volatility into a super high single-minded breakout move that positions you to be leveraged and strong in an aggressive fashion to the upside or even the downside, with very tight risk management and disproportionate asymmetric upside rewards. These things are rare and unique, and you could see the original structure break here at 4, which is the gold divided by the Dixie valuation. You would have had around 100 guesstimation. It's usually around there, goes up to 120, sometimes it goes to 80, but most of the time around 100. I would have told you were less than, you were around $300 or $400. It coincided with 2003. Don't forget you'd been about 255 in 2001. That was your breakout and pure confirmation for your gold bull market, and you then ran for the better part of valuation 22 from 4, a 5x in your relative gold valuation compared to whatever the dollar index was during that period. So you could hold a basket of dollar index currencies, or you could have been in an instrument that did 5 times that. In actual fact, according to our geometry, we allowed all the way to 2027 for that time frame target to be achieved. And when was it achieved? Well in advance in 2011, the localized high on a breakout that happened in 03, the end of 03. It's important to highlight the end of 03, September, and you were done. You were done over there. You can see it perfectly in July 11. So less, 7.5 years, and you've done your 5x relative to the index. And that was decent to good, but I'm here to tell you it's nothing like what comes next. By the way, before I tell you about what comes next, just look at the clear-cut absolute compliance on macro charts when rebased on an HVF setup. The second interim run, well, actually the first interim run right here, you've got to break up and then you've got a return move perfectly on the first interim target make. Post the second interim target being made, after a one-sided going up period, you got your first significant slam where you might have had adverse price behavior to your eventual expectation. What was it? The events of 2008 and 9, minor events you might say, that involved the bankruptcy of Lehman Bank, the ex-plantation slave owner. Go check out that history there. Corporation that involved the Lehman's family. All the way up, and finishing very promptly thereafter, making target, for which progress, decay, and a period of not being overly invested in gold would have been a good idea. You see, the difference between believers and cults is that they always only ever see time for you to do what they mention. We are not a gold cult. There was a time not to be in gold, and that certainly occurred after the target run of 22, which is gold price divided by the Dixie. Dixie would have been in the lower side, probably below 100, and you're at $1,927, and you're at about 95 for the Dixie. That is why you got the 22, both very close, one close to 100, the other close to 2,000. You had a pullback. You then got resisted over here and you sold off again. This hard sell-off period came during what year, you ask? Well, there you go. There you also had the 2020 period that was in and around in between these two. There's 3 years in that. 2020 was here. That just led to a wick downside. We are, of course, on a 2-monthly chart. So every candle represents 2 months. So what's the big sell? Why am I making such a fuss about this chart? Why is it my favorite chart? A community member reminded me of this one today. In fact, we'd already done the draws and I hadn't looked at it in a while because we have so many cross-market draws. Here's what I want to show you. I'm going to revert this back away from log scale back to regular scale. And what you'll actually see is that the current setup is actually bigger and producing a far greater reward than the existing one that has already completed. So we'll say goodbye to the previous one that ran you up from 4 to 22 and subsequently saw you come quite some way back down to 10 to highlight the current setup structure that you are now in. The current setup structure that you are now in. Let's wipe our face there a little bit, tidy up. And this is where you are. Fine, beautiful people. What chart are you looking at? Reminder, again, 2-monthly chart that is showing you gold divided by the Dixie. If you want to thank us for building any form of wealth and saving and protecting your money from the draconian system, the only way you help us is you utilize the links below by buying gold. We want the best for you. We've always told you our best opinion. We have not become believers or cultists. There will be a time to sell, and just as you should have sold at 22, so you should sell at 46. Although there will be likely some overperformance and it could be extreme and very volatile, taking off at least 50% and putting into other assets that have become underappreciated may well serve very well, though there is always a point to sell. Where was this at the just-in-time breakout? It was at 20.27, below the previous target, which was 22.4, and the absolute high, which was around 25. In fact, you've only just beginning, and that makes this a doubly historic moment, you're only just beginning crossing over that legacy high again. You're only just beginning, just crossing that legacy high. What was that high? Let's have it again. 25,785, and you're just not there yet. 25.656. By the way, since triggering, you had a break and feign, pull back inside 1, 2, 3, 4. Those 4 candles represent 8 months. If you include the one that triggered there, you actually have 10 and 12 months, a year with only one set of 2 months mildly red. You are heading for your first interim. This break, by the way, was at 20,000. This is 45. That is 45 on the Dixie, 20 to 45. You're looking at another doubler plus 25%, another doubler plus 25%, which is going to be in the Dixie terms, significant, expansive move with the potential for blow off. So this is a gold setup. This is a gold setup as based in all the currencies that make up the basket of the dollar index at present. And even engaging at these levels at 25, you probably have another 2x to go at minimum in terms of the Dixie index just getting up there, which is a huge move, a huge move. I would argue at 45, let's say the dollar index is around its 100 level, because it's usually there rounds. At 45, at 100 level, you're dividing by the Dixie at 45, you're talking $4,500 gold. $4,500 gold. Bear in mind the dollar is being weak right now. If the dollar index is down by 90 or 80 and you are dividing by a weaker number, it will be slightly less. If the dollar reasserts in strength, as the dollar milkshake theory suggests, at some point you get a spike because people can't pay their loans back, etc. You will actually have higher than 4.5 at this level. In other words, if the dollar index is around 120 and you multiply that by 45, you're going to get a significantly higher number. Could be 5,000, 5,500 and further. There are real technical setups all the way along for the numbers we mentioned. Never in Bitcoin do we ever throw out a number or gold or anything else that is just a massive number to be the biggest bull, to show how butch and how alpha we are. We throw out the biggest number. We're the real bulls in the house. It is always based on technical structures that we have been able to find, draw, that have targets, utilizing the HVF method that has served us consistently for our entire trading careers and is a high probability, likely outcome of a fast-moving breakout taken with short risk and a massive asymmetric upside move. That is who we are. That is what we talk about. That is a technical structure. That is telling you 5,000, 4.5, 5,000. Another reason why you're looking at levels like that made. By the way, the timing that took, you had until 27 on the previous pattern to make the target. It was done in 11. It was done in 7.5 years, far faster. It's a maximum allowance. This move is a smaller pattern and has a far shorter time frame. If you were to do this move in the proportionate same time, you would, instead of taking that period, would be looking to finish very, very soon. Probably my guess would be during 25, 26, maybe 27, you could be done in an exceptional set of circumstances, assuming a similar degree of outperformance. So this is very much on the cards for gold. This was the USD JPY. We spoke going into this one. Could it actually come out of this range? Why would it go up in value, the yen, in an environment where they supposedly have so much debt? And people will tell you they have around 300% debt to GDP. Well, I'm here to tell you that the dollar has around 700% plus when you include its unfunded liabilities. I'll also point out that with a cheap yen, the likes of Toyota and many other things are really, really exporting, and they still are a high-tech manufacturer. What do you export? Like Britain, that got pivoted to services and banking, they have nothing now of their manufacturing left, especially high value, high tech manufacturing. This turns into a great problem. People that make stuff that are of use to others have an income. Services, flaky services, which are lawyers in derivative contracts, once those Ponzi schemes have unwound, are going to find themselves in very difficult positions. The fact that the yen skidded through this low over here probably tells me that we didn't set up a massive continuation pattern for a big spill to the downside. Probably tells me, in terms of the Fed decision, that it's possible that either the 50 basis points is already well baked in, and that's happened, or you're going to get the 25. If we had made a strong continuation pattern that had yet to break, I would have gone more hard on the 50 basis points. I still think it's possible, but it may be leaked that they're going to come in strong, and that's why you've already started to get the downside. So I'm a little uncertain as to 25 or 50. Here's the other thing that makes me wonder about the 50. We talk about the 3 times strike on a broadening structure. 3 times you must hit. This is all part of 1, because that's when you return properly to the bottom. That is all part of a 2nd. So this is all part of a 3rd. And we break on the 4th. This is silver we're looking at on the daily. Many people say, talk to me about silver. Silver good, but as with gold, we need 3 touches and repelled, and the 4th is the break. It doesn't need a big pullback. It can pull back to our green level, which is part of a macro upside HVF, which is a triggering event. In short, on this daily chart, we are still at the break and feign back in stage of a far larger upside projection for silver. So we could have a little dip back, then the 4th move, if properly separate and independent from this move up. Here, if we can make the case for that being properly and separate, it might need to be a bit deeper or spend a bit more time before it goes. Then you will be looking at the beginning of the breakout out of what is a continuation pattern for us, much the same as Bitcoin. However, this was Bitcoin at 70K and at our capping descending grind line, and then the carry trade came. It's not impossible that if you had a major demand destroying event, you could go back to the other side or back here. I don't think it's particularly likely with silver you'll go that way, but if we had sufficiently enough economic crisis, you could have it. You could get back to the splitter, and then only on the return, the fourth time is the break in this set of circumstances for upside continuation. So for that to happen, if I think back to the Fed decision, a 2 basis points cut, unless it's been fully priced in here and it's well signaled, which I don't feel it is, it seems a 50-50 call, would be supportive for further upside on silver. So a 1 basis cut with further dovish opinions for the future and potential for next rates, they might not want to look too panicky. And that could actually initially disappoint sufficiently to bring it down before the next rate cut looks like it has to be a 2 at minimum, or even some might start mooting even more, and that's when you then get your move. So it does point a little bit to 25 basis points more than 30 for me, which is interesting because I think the economy is weaker than we understand. I think they're learning that it's weaker if they ever had any doubts, and they are usually late to start a cutting rate, but they might not want to panic cut with 2. I don't know. So I wouldn't rule out the 25 basis point cuts, and that could see a little bit of a pullback on the precious metals. Don't forget, we had a smaller time frame HVF for the 2575 on gold. You've done your 2580s. Now it might just need a tiny bit on the shorter time frames. Note how we've now moved from looking at 2 monthly charts with macro positions talking years versus talking about a Fed decision this week and what the near-term price behavior might actually produce. So be careful, understand the time zones in all of this. I think we've largely done this. Supporting this notion as well would be the fact that other softs that I'm watching are showing shooting stars. As strong as they've been, coffee, both cocoa and coffee shown shooting stars. There is economic events that are coming this week, and if they went too strong on the rate cuts, they could push the commodity complex, gold complex, silver complex too far, and they could be signal panic that could see a bit too much of a blow-off run in the soft commodities. Is this showing us something by its rejection? I'm just throwing in another commodity, nothing to do with metals, and I'm saying it's similar to cocoa, it's similar to Arabica, it's similar to Robusta, a little bit of nerves, Maybe it's a 0.25 and they're trying to lay it calm, or if they do the 50s, there's a degree of panic in terms of, will the demand be there for the product? How crushed is the consumer really? What do they know? So it's a bit difficult to interpret what to expect, but this does look like a little bit of a slowing on the softs there after reaching new highs. And this does point to potential for me for a silver pullback before a break. And that probably suggests that gold will too, and that there might be a little bit of a bid up on the dollar. Let's go back to the dollar on the short term, but our expectation is, as we've said, that it's broadly overvalued. You're playing with this line and level again. Let's go to the 4 hourly and just show you. This could get a little bit of a bounce off a key level. The fear is once 10.5 goes, it's a run straight through for the 100 mark and you trade 90s, which is psychological, very psychological. So what will happen between here and there? That is a kind of ledge, and we will hear on Wednesday when the Federal Reserve speaks. There you go. My favorite charts here. I've shown you a smaller time frame setup on the Dixie for gold. Where was it? Let's show it to you there. And why we see another doubling relative to the basket of the currencies in here on a much smaller time frame, why you are continuing to get upside structures all the way through, and that I expect further upside structures to form, and that gold is a secular bull hold that you should absolutely have in your portfolio, and that you're going to get outperformance on. And this is typical second continuation forming at the target levels of the previous macro continuation and the bias that saw us call the gold JPY, which has been one of the greatest charts of them all, even in spite of the recent strength of the yen. Okay, pure gold link below for all those rest of the world, ITM trading for the Americans, and to book a call on how to build your wealth whilst this reset process is going, plus to be in our community. Only once you are in our community, the reset options for a free call as a community member for building your plan to build optionality. Other nations that you holiday in outside the Western Hemisphere that you have a little look around with. Slowly getting banking outside your main nation, slowly getting tax residencies outside your main nation, getting a second passport potentially, also building other residencies, driver's license, everything that establishes you a full new avatar of identity in a country that is diametrically opposed to the current communistic totalitarianism that is being forced on the white European nations of the Commonwealth, North America, Europe, Britain, and the rest. Do yourself a favor. Start now. In the USSR, by the time the curtain fell, you could never leave. They could not travel, they could not go anywhere. A, the assets get devalued. B, the quality of living starts to reduce. C, everyone starts to stampede. D, they lock you in because you're all stampeding. Don't wait to be in the normal curve of the mass. Leave someone else to switch the goddamn light out. Have your optionality available. We work with you in terms of a plan. You will have a call with our experts exactly on that, on how you can establish banking, tax residency that doesn't even have to be where you live, offboarding of profits from trading accounts, even including crypto, to a bank that is approved and works with that bank in a country where you will continue to be able to have multi-currency account and spend and live anywhere in the world off of that card. Buy your freedom to roam. It is not the time to be a stay-at-home bod. Every holiday should be an exploration holiday into a new region, and I would suggest start looking around from Southern Africa, Indonesia, Philippines, certain Latin American nations, Eastern Europe, but a little bit of the war thing, and other places. All are viable options that are non-Western and are a little bit less aggressive on the trajectory that Canada, Australia, and soon to be America will be on. Do that whilst building wealth, getting the potential to manage your wealth offshore remotely, anywhere from a computer with an internet connection, as well as doing other potentially productive things to support your trading, could be the beginning of a new life for you and your family. Do not sit and watch the slow creeping totalitarianism. Once it crosses a line with you that you can't take anymore, the rest will be doing the same thing. You will fail to be ahead of the curve and you'll be trapped. You'll be made to pay more and your assets probably in real terms will have devalued. At the moment, you can come with your relative Western wealth and be kings and lords in what are third world nations, just on account of moving now. This will not always be the case. Okay, that's me done preaching. Gold is truth. Until it's no longer clear that you must be a holder of it, gold is the truth of the fiat devaluation, debt-based collapse that you need to understand. And we aim to keep you long in the things that will help to make you money. That is what we do as service for everyone watching here. Please understand that we give further service to people that recognize our efforts by joining our community and booking a call. We have limited trading metamorphosis programs now available. Hit that book a call button. If you want to just buy gold, utilize our links. Thanks, you will pay exactly what I pay in terms of everything I purchase. Thank you so much for watching. Hit the share button as well. We'll catch you next time. Bye for now.